Well, I hope everyone's all fed up and doesn't fall asleep now, so we'll get us through for the next little bit of time. What we're just going to cover off now is a bit about who we are, so you know who we are, and a lot of you do already, but for those new ones, welcome. The main company today was Loans USA. That was a company I really set up off the back of our main company, which is Loans Australia, which has been operating now for about 17 years in Australia, predominantly dealing with investors and helping them with their finance in Australia. And really what happened is about 4 years ago I wanted to diversify my property portfolio in Australia to try and find some cash flow, because all of it was negatively geared. Some now have gone into positive, but after a long period of time. And I started looking at the US because our Aussie dollar was high about 4 years ago, and I found it a little bit tough. Like most people, the first port of call I did was get on the internet and start Googling about the US. I wanted to find out what people were doing, and back then not many people were doing a lot, but some were. And I found out, by and large, the biggest issue was property management by far. The people who had invested had a lot of problems getting their property managed properly, receiving their money, getting service calls, actually even verifying that work that they thought was done on the property was actually done, and it was a nightmare. And in the early days, a lot of people were investing in upstate New York, was a predominant area that people were promoting, and that unfortunately, as we've seen on something like Today Tonight, all these people bought into the market there during the boom, and they've gone bust. Unfortunately, just a cycle issue for them. But certainly now, in the last couple of years, we've had a fantastic opportunity, and I've spoken to a couple of people who've got into the market, like myself, a few years ago, and are doing really well, which is good. Loans USA started basically 2 years ago when I started buying my first property. It took me 2 years to get a property. I used a buyer's advocate because I couldn't do it all myself. They got me into the market, but the problem is they didn't offer finance, so I had to pay cash. And like probably most of you, you've grown up around leverage, and the only way to really get forward quickly is to try and leverage. So having a financing background, I started researching the market over there to see whether there are any opportunities, and I started going over to the US and spending a huge amount of time on the phone each night trying to speak to people who may be able to help me. And what I found out fairly quickly is a lot of people weren't lending. And even mortgage brokers, which was one of my first port of calls, because that's what we did in Australia, I spoke to a lot of them. And I found a couple in Florida who were specialising in foreign nationals. That's what they call us, because there are still a lot of Canadians and English people and Germans buying in Florida. And so I spoke to a few of those, and most of those only had one or two lenders. But they said 3 years ago, if you rang me then, I had about 30. So it's been pretty tough, but I learned very quickly what we needed and how we needed to borrow, and that's how Loans USA sort of sprung up 2 years ago. We do, like it says down the bottom, have an ASIC licence. We're the only company in Australia to have a licence to deal in the US. No one else does, and that may change, I don't know, but at the moment we're the only one who's gone through that process. Loans USA also has a similar licence which you need these days to operate in the market in finance. We've got a number of people from our company here today, which you'll meet throughout the day. But one of the other companies we put together is one called International Portfolio Group. When you start buying in America, and a lot of you have, you'll understand that you have to comply with their laws. So one of the things you have to do is you've got to put a tax return in. It's amazing, that little thing of a tax return stumps a lot of people. I've actually met quite a few people in the last 2.5 years who have never put a tax return in the US. And they think, oh, it's all nice and easy. I've just got this money coming in my bank account. I'll just go and spend it. Taxes, I'll just worry about that a few years down the track. It's amazing. Eventually the IRS will find them and they'll get in a bit of trouble. So one of the things I wanted to do, actually, because we comply, is to make sure our clients are going to comply all the way through. So I spoke to a chap earlier I know, and he's used, like we did initially, American focused accounting firm in Melbourne who had ties over there and set up structures for clients and things like that. But what we found is they're very, very expensive, and we actually found some of their advice wasn't top shelf. So we went and sourced accountants and attorneys in America for our clients at about a third of the price, and we believe much better advice as well. So you'll hear a bit from them today, actually on video because they couldn't be here live, to give you a really good explanation of how the tax situation works, and also from the legal side. Because one of the first things you'll need to decide is, how do I structure my investment? What name should I have it in? So we will talk about that today, because that's a really important thing as you build your portfolio. From asset protection, from a tax perspective, so we will have a look at that. Then the last sort of company we sort of put together was American Property Partners, and that's the property side of what we do. And the first couple of years we just focused purely on finance. But what we found is that we were getting more and more requests from people to try and help them on the property side, because companies that are out there perhaps weren't doing a great job. Most of them didn't offer finance. They're all cash only. So at the end of the day, my belief is if you're just paying cash all the time, you're not going to get the leverage unless you've got millions of dollars at your disposal. You're going to be stopped very quickly. And also having finance gives a second person's opinion as to the value of your property as well, which helps as well. So American Property Partners, or we call it APP, set up recently to try and help our clients move forward quickly with properties which can be financed. You can certainly pay cash, but every property that comes through will finance for you if you want to. At the moment, I've got 8 properties. I've bought another 5, which we haven't, what we call closed. That's a terminology thing you'll learn when you start investing in the US. All their terms are different. We call it settling over here, but they call it closing a property over there. My goal is to get to 30 by the end of the next year, and I'm sure I will. And once you start getting the bug for the US and understand how the finance works, I'm sure you'll want to build a good portfolio as well, because it certainly is achievable. In Australia, it's very hard to build a big portfolio because every time you buy, you're paying huge stamp duties, and if you sell, there's big exit costs over here. But in America, the price points are so low, leverage is possible, there's no stamp duty, and if you do sell and you roll over that money very quickly into another property, you can actually roll over the capital gains tax requirement as well, which we don't have in Australia. So a lot of their taxes you'll find as you go along aren't that bad compared to what we're facing in Australia. I always use this slide, and some of you have probably seen it 3 or 4 times if you've been to a few seminars. The main reason I keep putting it up is, I like hippos, but the philosophy about it, a lot of people in Australia, and we've got about 1,600 Australian finance clients, majority of them are negative geared type clients, ones who've bought properties in inner cities of Australia, who are building a portfolio and relying on capital growth to make money at the end of the day. And what we've found, if you've been invested for quite a few years, is that the only way you make money from negative gearing is capital growth. So you're going to hope over a period of time that property will go up in value and you'll make some money back, because negative gearing means you're losing money. And if you're building a lot of properties, it means that every month you've got to find a whole pool of money to keep feeding the beast. And I like to say the hungry hippo's at your back pocket trying to grab more money out every month. And that was the reason I got into the US. I always tend to put this slide up too, because most people, when they start buying assets, they're always proud of their first one. And this is my first little property I bought in the US over 2 years ago. It's a tiny, well, it's not actually that tiny. It's a 78 metre squared 1-bedroom apartment. And for those of you who know sizing, that's actually a pretty good size for a 1-bedder. It's downtown Orlando, which you will hear about Orlando today. It's only 8 minutes from the CBD. We're on our second tenant now in just over 2 years. We had, I think, 1 week between the two moving over, which was okay with me. So that was pretty good. I only paid $31,000 for it, a 1-bedroom unit. Last sold before me for $156,000, so someone lost a lot of money. But the good thing is I'm going to make the money back. One thing I love about this apartment, it only rents for $650, but it's the first time I've ever bought an investment property where I've made money in year 1. Never had that before. I don't know if anyone's different. Maybe you've bought in a mining town or rural town or something like that, but my philosophy was to buying cities. But it's the first time I've actually made some money, so I'm pretty happy. I don't actually mind paying tax if I make money, so it's not a bad thing. So it's not a lot of money, a few $1,000s, but look, if you're buying 20 or 30 of them and some are a bit bigger than that, you're going to make a bit more money. So it's not a bad way to go. Now, why you should invest in the US, or why you're looking at it, of all the seminars we've done in the last few years, we always ask people, why you should do it. And these are always the common reasons of why people are looking at it. The first one is high rent returns. Now, the rent returns can be even higher than that. And what you must take into account is risk and reward. The higher the return is, you've got to understand the higher the risk is generally going to be. And I know some people, like myself, have also invested in what we call the inner urban areas of these cities. And what happens when you invest in these inner urban areas, the prices are much lower and the rents are pretty much the same. A little bit lower, but not much lower. So that means the net return is going to be much higher. Like a couple of my properties, my gross returns are 40%. 40%. That's the rent divided by the purchase price. And the nets are well over 25 to 30%. Now, the risk in those areas are much higher. So that's one of the things you need to understand when you're working out where you're going to invest and what you're going to invest in. You have to work out what sort of risk you're willing to take and understand if you're buying a property for $20,000, $30,000, $40,000, you've got to understand that they're going to be higher risk proposition than a house which is 60, 70, 80. A lot of people don't really understand that because no one really explains what you're going to really get if you buy a cheap property. and which we will talk about that, because most companies in Australia advertising investment properties in the US are mainly talking cheap, and they don't really explain to people what that means to you as an investor. Because a lot of people get a bit worried, or they can't sleep at night if they don't see the rent going in on the 1st. They can't handle if the rent comes in on the 15th or the 16th, or the manager sends you an email, oh, they're going to be late, they're going to catch it up. So if you're one of those investors who wants to sleep easy at night, I'd suggest definitely do not buy a cheap property, because you will not have a pain-free experience. If you want a pain-free experience, buy a more expensive property. Do not buy cheap, because you will not get a pain-free, stress-free, worry-free experience. It won't happen. So I just want to, I'm sure you got the drift of what I'm saying. Gross yields, look, they're very high. You know, in Australia, everywhere I go, people say they're happy. 4-5% gross return is standard, and people are happy, and we've been spending that sort of and buying those sort of properties for years. In America, the only reason we can look at returns of 20%, 15-20%, is because the properties have gone down. It's not that the rents have; the rents are pretty stable, but it's just the value of the properties have gone down. And as we'll have a look at later, 5 or 6 years ago, they were buying properties hand over fist at 5% yield. But now the price has gone down, so the yields have gone up. So we're just in this equilibrium where, at the moment, we can buy properties at much higher yields than traditionally we could have. Prices, yes, they are low, even from $45,000. Most of the areas we focus on, we're not focusing on the cheaper end of town. We want properties which we can finance. One of the things you'll find out is the cheaper the property, it's very hard to finance. It's going to be in parts of town where banks don't want to be. It's going to be in parts of town where most people don't want to live. If they can get out of there, they've got out of there. So you're renting to people who perhaps are very low socioeconomic. They're never going to be able to get a mortgage. They're always going to have credit problems. One stat that most people don't realise, or they may have heard me talk about before, is that 28% of Americans don't have a bank account. Don't have a bank account, which shocked me. It's a cash economy. A lot of these people rely on cash. So in some parts of where we have properties, and if you're in the cheaper end of town, how they actually pay rent, some of these people, is a system called a Dropbox, which basically means that the cash they've got, they put in an envelope, which they're given by the manager, and there's like a post office box. They go down once a fortnight or once a week and pop the envelope in the box. And if they don't pay, then a few days later they might get a rat-a-tat-tat on the door saying, where's your rent? You've got to pay. So what you find is over there, the property management expenses are between 8 and 12%. So you're not going to get 5 or 6% because it can be a very labour-intensive exercise. Plus, overall, their rents are lower. They're not as high as what we pay over here. You'll be surprised what you can rent a beautiful, big 4-bedroom house for. Much cheaper than what we can over here. Purchase property below replacement value. And this is economically one of the best things I like, is that, as I mentioned at the beginning, we're buying properties at half, on average, the cost of what it costs to build. Eventually, building will come back. Stock will be soaked up. Prices will rise to at least where it costs to build a property, which is a big thing. So if you can build a property for $180,000, but you can buy it for $80,000 or $90,000, you can't go wrong eventually. You can't go wrong. And at the moment, there's nothing for land. There's no land value there. You're just buying the building. And there's no market we're in where you are buying at replacement value or anywhere near it. All of them below replacement value. And look, there is, as I mentioned, there is a strategic shift to renting. If you've got all this pool of people out there who've been foreclosed, they've got to live somewhere. They have to rent. Strong Aussie dollar. Only in the last few days, it's gone down to $1.03. And we actually have some clients now who not only buy properties, but actually trade the currency because it's been so volatile. Our foreign exchange dealer told us at the moment it's trading between a band of $1.03 and $1.06 and sort of bouncing between those at the moment. And so people are moving money just on the currency to make a little bit of money there if you've got the money to do that. Traditionally, our dollar has travelled about the 65 to 68 cent margin. So at the moment, we're up here, the dollar was down here normally. Eventually, it's going to get back down there. So not only can we make money on cash flow, not only have we got potential to make money on capital growth when it eventually goes back up, but we're definitely going to make money on currency. Even if the currency goes up a bit higher, which would be fantastic, because then we get even bigger discounts when we buy them, eventually when it goes back down, we're going to make money when we bring the money back to Australia. In Australia, we can't make money on currency movement. Over here, we can. It is the largest economy in the world. And look, people get worried about, okay, America could have a double-dip recession. You hear that word, but the bottom line is when they got their credit rating got re-rated and went downgraded last year, what happened? People were worried about, oh no, money's going to come out of America. But what really happened is that more money came into America, the reverse, because it's still the safe haven around the world. people still believe America is a safe haven and it is a big economy and it will bounce back. So it gives us a bit of confidence. And the thing I like probably the most is no stamp duty. So we do save a bit of money there as well. That's just a bit of graph about the dollar. The 10-year average is 68 cents and the low point's actually 48 cents. About 11 years ago, the Aussie dollar was trading at 48 cents. I'm sure there's a few people in the room who may remember that. And look, I like to be a bit of an optimist. So let's take a crystal ball. Let's pretend this one works. And we're looking 10 years down the track, and the Aussie dollar, something's happened to our economy. Maybe China's gone off the boil a bit, and our dollars come back down, or maybe the euros closed down, and so all the money flies into America. Their dollar goes up, our dollar goes down. It goes back down to say 50 cents to where it was. That means it's basically half from where it is today. And let's say our properties have done okay, and they've risen, and they've doubled back to at least replacement value. So that means that on the bright side, you could actually have a quadrupling of your investment in 10 years. And that's not too far-fetched. It could happen. But what chances have we got of buying a property today in Australia and having that quadruple in 10 years? I don't know, but I don't think very high. That's one of the reasons I only invest over there now. These are three big reasons why people are looking to invest in the US. When you invest in anything, you've got to have a goal. You've got to have a reason. And these are the three big ones. Early retirement. A lot of people I talk to are wanting to replace their income. They've had a tough trot. If you're sort of 55 plus, you've had a tough trot with the superannuation returns in the last few years. And at least when you own a property, you know what the cash flows are going to be. With share market, you completely, you don't know what's going to happen at all. So that's a big reason for people to build up their cash towards retirement. A lot of people in Australia, and I have a lot of clients in the southern eastern suburbs, and a lot of these people have relied on their equity in their house to fund their kids' education. But if the houses don't continue to go up in value, you won't have the equity to pull out to pay for your kids' schooling. So that is a concern for some people. But you can buy properties, cheap properties in America, like in Kansas City or Memphis, and these sort of places, which are 50 or 60,000. You could pay them off completely in 5 or 6 years with just the cash flow from the property. So you don't put anything in yourself. You just use the rent coming in, pay your expenses, pay your mortgage, and you can have it completely paid off in 5 to 7 years, which is phenomenal. And that will help you. Then you could sell your property if you want to, pay your kids' education, get your equity out if you can, and that's a great strategy. And also mortgage payments. Some people are trying to negate some of their negative gearing and get some cash flow over there to smooth it out a bit. That's another big reason. They're the three big reasons we see. Foreclosures have tripled in America. Went from 5% to 14% of America was in foreclosure. 14%. That's a phenomenal number. Delinquent loans, it's like people not paying their loans on time. Went from under 1 million to 6 million delinquent loans. That's like a quarter of Australia's population in delinquent loans. It's distressed sales under 500,000 up to 1.6 million where they had to go. And supply and demand, well, the supply got further out. It's harder to sell the properties because there's too much supply, which in some markets now is improving as well. So they've had a pretty bad situation. Yes?
What's the trend in foreclosures now?
I will get to that because that's, I'll cover it now. In the high foreclosure states, what's happened traditionally is that there's about 4.5 million what they call foreclosure which haven't hit the market in the last 2 years. They've been held back. Obama didn't want to hit the market and have another double dip recession, so they've been held back. I've been trying to buy in Phoenix, Arizona for quite a while, and we keep chasing the price up because there's not enough supply. So what they've now done is, I don't know if it's because of the election coming up, is that they've passed a new law allowing Wall Street to come in and buy big bundles of foreclosures. We're seeing it right now in Atlanta. And so what they're doing is instead of Fannie Mae and Freddie Mac releasing foreclosures to the markets to sell off, what they're now doing is taking them all back, pooling them up and selling them off in massive bundles to investment firms on Wall Street. But what they're doing is they're saying to them is you cannot resell them for 5 to 10 years. So they're going to be taken off the market, they'll just rent them out, and it will hopefully stop the prices going down any further and stabilise the market. That's the best solution they've come up with and what they're doing, and that came in December, and now we're seeing it in a couple of major markets. Phoenix, they're doing it in Atlanta. The big markets where all the foreclosures were, they weren't happy with how long it was taking to sell properties in Atlanta. There was like a 9-month overhang of supply and there's too much, and so that's what they've done. So our people in Atlanta who are buying properties have told us in the last 3 months it's been very difficult to buy foreclosures. They're actually bidding on a 640 pool block of houses now to try and buy that. So it is very difficult. It's getting harder. And you'll speak to Southwest Florida, and they'll tell you about their supply and demand issues they're having there as well. So it's not just in Atlanta, it's other markets where the supply is getting less. But we also got to remember, it's been 6 years in some markets when the boom peaked and the bust happened. So there has been quite a long period of time in some markets where there's been basically no building, and so eventually the supply gets eaten up. Hopefully that answered it.
So what happens is in 10 years when they release all these houses for sale, then you've got an oversupply.
We don't know. We're not sure what they're going to do. Of the 10 years...
There where all these firms are buying these properties,
Yep.
and they can't sell them for 5 to 10, when they release them for sale, they've got an oversupply, therefore lowering your house that you've got there, lowering the value of your house.
Well, that's a possibility, but by that time, the whole market would have changed and the dynamics would be different. And we're hoping then all these people who've been foreclosed can now get loans, so the demand's going to be back there again for those sort of people buying houses. But at the moment, there's so many millions of people who can't get a loan and have to rent.
That's why the high rental returns.
Oh no, the rents haven't changed.
Everyone has to rent because they can't buy a house because they've got bad credit.
Rents will actually go up. We're being told by the property managers rents are going to start to go up. In the last few years, they haven't moved. They haven't gone down, but they haven't gone up. And what will happen, some of these big firms will sell the properties back into the market, but we're not talking about 20 million homes. There could be a few million homes scattered around America. It's only 4 million that are foreclosed now.
I find it very ironic that they're doing a deal with the same people that caused the market to crash.
Well, so is Donald Trump. That's what his whole video was about.
Ridiculous, isn't
You're
it?
giving money back to people who caused the problem.
Yeah.
And well, I don't know if it's politically motivated, but there's an election coming up. And I'm sure he'd rather have that news than having 4 million people, foreclosures everywhere. But I can't really comment on American politics.
How can you work out, or do you have some sort of a trend where you can see if the rent will go up or down, or previous years if it's gone up, because that's why you're getting the high return, because the rent stayed the same but the property's gone down.
Correct.
So if you can't really say if the rents are going to go up, it's not like here.
No,
So-
supply. Well, the best answer to that is to ask the property managers to come up here who do it every day. But we're being told the rents will start to tick up again soon. When there's less supply, it has to go. It's all supply and demand. That's all it is. And then if there's not enough supply, price goes up. That's all that happens. And also once more jobs come on the market and the economy's improving. Last few years they've had a really tough time. It's not as if they've had a good time over there. And so you can't put rents up if people are struggling. That's for sure. We really believe there is a few years left to go. The last load of foreclosures of the subprime lending happens this year. As I mentioned to a few people over breakfast, the foreclosures which are actually happening now, a lot of them are actually middle class people. And one of the people here were telling me about their friend, unfortunately, in Phoenix. It's not uncommon that they, as I mentioned before, they had a house priced up here, mortgages now still up there, but the house is valued there. And look, they had jobs. Doesn't matter who the person was, but they had jobs just like a lot of Americans. But it's just a big disparity, and they're trying to stay in their house because it's their house, it's their home, as they say in Australia, their castle. So a lot of these middle class are now being affected with the foreclosures, and they're trying to hang on because they know the price will eventually go up, and because they have the income, that's a good way to go if they can. That's just a little summary of how to take advantage of the opportunity. You've got to buy smart. You've got to hold for the medium or long term. Don't expect to make profit overnight. Some markets you might make a bit of money, but strong income. And that's where you really need to focus on the income, because we don't know when capital growth is going to happen. But at least you can see the bottom line every month when the money hits the bank account, and then high capital gain eventually. Certainly in some of these locations where it's gone down 70%, history tells us that it will start to go up again at some stage. You'll make some money on the way up. That's just a bit of overview of the key parameters and all those parameters there. One of the big things is management. One of the things we do to monitor that is we're in the States a lot. We talk to our managers all the time. And if, the managers aren't doing a good job, we're on top of them and we'll replace them with someone else. Because we have so many clients buying all these areas of America, it's a great source of business for them as well. And we focus on managers who deal with international clients because it's much easier to do it that way, and you'll find that if you're already an owner, which some of you already are, that if they are investment focused and they are international focused, you're going to have a much better time, better experience dealing with your investment managers. This is basically the model they all have to go through. There's a lot of properties generally out there. It is dwindling in some places now. They're going to have to view a lot of properties. They'll source a few of those, They'll research a couple and they'll acquire even fewer. There might be 1,000 foreclosures out there, but not all those are going to meet the model that these investment companies want. And or even Orlando today will go through exactly what their model is because it's very specific. And so if it doesn't fit their model, they don't buy the property off the banks. So there is a lot of work from their end to get the end product that's going to make sense. They source their properties from a lot of different areas. Most of the people you'll see today generally buy in bulk off bank or what they call asset managers, like Fannie Mae and Freddie Mac, who are holding these pool of properties. Around the world, there are a lot of foreigners buying in America. It's not just us. We're unfortunately just a little blip, but hopefully with more and more education out there, and I know there's a couple of shows on television now coming through and radio and things like that, newspaper, but not much press there has been so far, but hopefully more will come. Last year, up to April 11, $82 billion was spent on US investment property. Before that, it was $64 billion, and the year before that, $36. I'm sure this year, when the figures come out, it will be even higher. So more and more people are going in there. And the great thing is, there's no restrictions. Anyone can buy in the US. There are a few countries they won't allow to do lending with them, but by and large, most countries are unrestricted in how they can buy, which is fantastic. In terms of where they're buying, majority of people, or foreigners we're talking about, are buying in the southern part of America. The only place that's in the north is New York, and looking at the research report I read, most of those tend to be Russians buying in New York. That's a favoured area for them. But by and large, they're all in the southern cities across New York. Florida's still by far and away the biggest. I think it's actually risen up to about 28% last year. But they're all across the southern. The biggest improver was Georgia, which is Atlanta. That went up from 1 to 5%, a 500% increase in activity in that marketplace. And once we look at the data, we can probably tell why, because that is the economic powerhouse of the southern part of America. It's got predicted to grow by another 2 million people in the next 20 years and 1 million more jobs. So a lot of economic reasons. And that's across the whole southern part of America. That's where the demographics are. The people are shifting there. The baby boomers are moving south. They're not moving up into the snow in the north. The population and the employment increases are all happening in the southern part. And look, most of the markets in the south we're in. We're not in any of the markets across the northern part of the country. Also, the returns are a bit more variable up there. The snow does cause issues, does cause more cost, so the yields potentially can be a lot lower. So there's so many opportunities in the south, we just stick to the south.